Well, let's turn to the advisory now, and CPA Australia claims the $3 million super tax will impact a greater number of Australians than is being acknowledged. To talk about that and also some reaction to the RBA rate cut, Elinor Kasapidis joining us from CPA Australia. Elinor, welcome to AusBiz. Thanks so much for joining us. Can I first start with the RBA? Of course, they have just cut interest rates again. From the CPA's point of view, what does this bring to the economy? How much support will it likely deliver?
It's a step in the right direction, and it's a good breathing space, particularly for mortgage holders who have been struggling for quite some time. We're very much focused on business, and it does give them a little bit of breathing room, but it's not necessarily a panacea for our productivity challenges. So what we're looking to see is inflation continue to stabilise. Further interest rate cuts would be good, because then businesses start to have excess capacity to look at investment, particularly in technology, and to accommodate some of these other rising costs.
All right, but obviously with the focus there for you on productivity, or the lack of it at the moment, and obviously the government now post-election is talking about that. What's required? Is it more about, I guess, removing some of those regulatory burdens?
Regulation is a real productivity killer. I think it's around having capacity, so giving businesses some money back so the interest rate cuts help, and enabling them to make good investment decisions. So part of it is government industrial policy supporting small business and larger as well to make investments in our future, as well as I think it's to look at ensuring that the growth in private investment, private capital investment is restored, because the public sector has crowded out a lot of the activity over the recent years.
Eleanor, let's talk to that other policy decision by the government, that is to place extra tax burden on super balances above $3 million. What are the issues that you see there at CPA? I see you're saying essentially this is going to affect a greater number of Australians that's actually been stated. Now, is this because of bracket creep? There is no indexation here.
That's right. And we see it on the income tax side as well. So as you have inflation, asset price increases, those people's superannuation balances with no safeguards or caps will start to breach that $3 million threshold. So while the government's saying 80,000 superannuation funds at the moment, over time, as Australians invest, especially younger ones, over the course of a working life, $3 million for our Gen Alphas is not unheard of for an average wage earner. So our concern really is that they're kicking the can down the road, and they're not putting safeguards in place and sort of retaining that concentrated burden at the top end.
So essentially they're saying this policy change should be consistent with the objectives of superannuation. This could actually discourage people to invest.
Of course, because we want all Australians to invest in their retirement. It puts them up for a better retirement and relieves the pension system. So where you put incentives that start to capture more and more middle Australians, or those who really want to invest appropriately for their retirement, it's not a good policy. And we don't want to see people driven away from the superannuation system, but rather to have clarity. And that's not to also say that a lot of people, farmers, business people, put property, other assets, illiquid assets into their superannuation fund as a result of policy decisions and being encouraged. And now they're being whacked with unrealised capital gains on a lot of those assets, which was completely unexpected.
Yeah, how difficult is that going to be actually to measure, to tax unrealised capital gains, and the effect that is likely to have, particularly on SMSEs and the like?
Exactly. So it's hard enough to calculate real capital gains. The system is really complex. Unrealised capital gains makes it even more difficult. Number one, because the taxpayer doesn't have any cash in their pocket. It's based on a paper value at a point in time and for a certain class of assets. So where you're not trading on share markets and things, you have illiquid assets, how are you supposed to pay a tax on a gain that's locked into land? Or similarly, if you have higher risk like venture capital or even crypto, things that are volatile, the paper value fluctuates so much that the taxation outcomes can be vastly unfair. So for us, this doesn't exist anywhere in the tax system, and we don't want to start seeing it in superannuation. And there's also the risk then that it gets extended out to income tax and further once you've got it as part of the system.
So, Eleanor, I imagine that there at CPA you are making representations to the government. Do you see any likelihood they're likely to move on this or not?
So this was a proposal that was put forward prior to the election. The bill lapsed, and the indication from government is that they will reintroduce it. And now with the Greens majority in the Senate, it is likely to pass. The Greens are actually proposing to lower the threshold to $2 million, which makes these problems even more difficult. So in that sense, we are asking the government to take a step back, look at good policy design, and we have no qualms with looking at the top end of superannuation funds and making sure they're taxed at the appropriate rate, and looking at the whole system to see how people are taxed over time. But things like unrealised capital gains and indexation are inappropriate and
Now,
unfair.